There is a quote that is widely considered to be the single most important lesson in professional speculation. It is a piece of wisdom so profound that it encapsulates an entire career, a complete philosophy of risk, and a lifetime of operating in the world's most demanding arena. The quote is this: "It's not whether you're right or wrong that's important, but how much money you make when you're right, and how much you lose when you're wrong." These are the words of George Soros, and to understand them is to understand the very essence of his genius. This statement is not a simple trading tip. It is the final, practical conclusion of a deep and complex philosophical framework. To analyze the career of George Soros is to analyze a figure unlike any other in financial history. He is not a value investor, not a technical trader, and not a quantitative analyst. He is an applied philosopher. The global markets were his laboratory, and his trades were a series of experiments designed to test his theories about the nature of reality, the limits of human knowledge, and the strange, recursive relationship between perception and events. To comprehend how Soros managed risk and became the world's most successful speculator, we must first deconstruct the intellectual architecture of his mind. We must set aside the charts and the financial statements and delve into the two core concepts that governed his every action: the principle of fallibility and the theory of reflexivity. These ideas, forged in the crucible of his early life and refined through his study of philosophy, are the indispensable keys to unlocking his methodology. This is not just the story of a speculator. It is the story of a thinker who found a way to translate a profound understanding of human error into a fortune. To understand George Soros the philosopher, one must first understand George Soros the survivor. His intellectual framework was not born in the sterile quiet of a university library. It was forged in the terrifying reality of Nazi-occupied Hungary in 1944. As a Jewish teenager living in Budapest, he was forced to navigate a world where the established social order had completely collapsed and was replaced by a murderous ideology. Survival depended not on following the rules, but on understanding that the rules could change in an instant. It depended on recognizing the vast and often fatal gap between the official pronouncements of the regime and the brutal reality on the ground. He and his family survived through the use of false identity papers, constantly moving, constantly adapting to a hostile and unpredictable environment. This formative experience instilled in him a deep, instinctual understanding of risk and a profound skepticism towards any system, whether political or financial, that presents itself as permanent, infallible, or absolute. His life taught him from a young age that any system, no matter how powerful it seems, contains the seeds of its own destruction. After the war, Hungary traded one totalitarian regime for another with the Soviet occupation. Soros managed to escape, eventually making his way to England as an impoverished student. It was there at the London School of Economics that he encountered the thinker who would provide the formal intellectual structure for his own developing worldview, the philosopher Karl Popper. Soros became a devoted student of Popper, whose work, particularly The Open Society and Its Enemies, had a seismic impact on his thinking. Popper's central contribution to the philosophy of science was the principle of falsification. He argued that scientific theories can never be definitively proven true, they can only be tested and proven false. The pursuit of knowledge, therefore, is not a journey towards absolute truth, but a continuous, iterative process of proposing theories, testing them against reality, and ruthlessly discarding or refining those that are found to be flawed. A good scientific theory is not one that is right, but one that is highly falsifiable yet has withstood repeated attempts to disprove it. This intellectual framework, the idea that the path to understanding lies in the active search for one's own errors, became the central operating system for George Soros's mind. He took this scientific principle and applied it to everything: politics, society, and most profitably to the financial markets. The first great pillar of Soros's philosophy is a direct application of Popper's ideas to the human condition. He calls it the principle of fallibility. The core of the principle is the assertion that human understanding is inherently and unavoidably flawed. There is always a divergence, a gap between reality as it is and our perception of that reality. This is not because we are unintelligent, but because our minds are part of the reality they are trying to understand. We are participants, not objective, godlike observers. As a result, our views are always biased based on incomplete information and subject to emotional distortion. Absolute truth is unattainable. This seemingly simple idea has profound implications. For Soros, it means that any model we create to understand the world, whether it is a scientific theory, a political ideology, or a financial valuation model, is necessarily a flawed and simplified caricature of a much more complex reality. This principle is a direct and radical attack on the foundations of classical economic theory, which is built upon the assumption of rational actors and efficient markets. The theory of the efficient market hypothesis, for example, posits that market prices at all times reflect all available information, and that participants act rationally on that information. Soros rejected this entire edifice. He argued that since the participants themselves are fallible, their understanding of the information is inherently flawed. Their biased, emotional, and often irrational decisions are what drive market prices. Therefore, the market cannot be a passive and perfect reflection of reality. It is instead a chaotic and often distorted reflection of the flawed perceptions of its fallible participants. As he famously quipped, "The generally accepted theory is that financial markets tend towards equilibrium and on the whole discount the future correctly. I operate using a different theory, according to which financial markets cannot possibly discount the future correctly, because they do not merely discount the future. They help to shape it." More important than its application to others, however, is how Soros applied the principle of fallibility most rigorously to himself. He began every major speculative campaign from a position of profound intellectual humility. He started with the assumption that his own thesis for a trade, no matter how well researched, was likely to be flawed or incomplete. His entire process was not about proving himself right. It was a constant, active search for the flaw in his own argument. He once stated, "I can be wrong. This is a strength, not a weakness. It is the recognition of my own fallibility that is the cornerstone of my success." This is the source of his famous lack of ego in managing his portfolio. Unlike the average trader who becomes emotionally attached to a position and defends it even when the market proves it wrong, Soros was in a perpetual state of readiness to abandon his own best ideas. His focus was not on being right, but on surviving to trade another day. His constant self-critique was his most powerful risk management tool. If fallibility is the diagnosis of the human condition, then Soros's second great pillar, the theory of reflexivity, describes how that condition manifests in the world, particularly in financial markets. This is his most original and most profound contribution to financial thought. It is the theory that explains the strange two-way feedback loops that drive the market's famous boom-bust cycles. The classical view of markets posits a simple, one-way relationship. The underlying fundamentals of the economy or a company are the reality, and market prices are a passive reflection of that reality. For example, a company's strong earnings, the fundamental reality, will cause its stock price to rise. Soros argued that this model is dangerously incomplete. He proposed that there is a constant two-way feedback loop between reality and perception. He identified two functions at play. The first is the cognitive function, where participants observe the world and form their beliefs and perceptions about it. The second is the participating function, where those participants then act on their beliefs, and their actions in turn have an impact on the world. In most areas of life, these two functions are independent. For example, a doctor diagnosing a patient with a disease does not, through the act of diagnosis, change the course of the disease. But in financial markets, Soros argued, the two functions are inextricably linked and interfere with each other. Participants' perceptions influence market prices, and those market prices in turn influence the underlying fundamentals that participants were trying to perceive in the first place. Let us deconstruct this with the classic example of a real estate bubble. The process begins with a prevailing bias, a flawed perception, as dictated by the principle of fallibility. In this case, the bias is, housing prices can only go up. This is the cognitive function at work. Based on this belief, people begin to act. They rush to buy houses, often taking on more debt than they can comfortably afford. Banks, sharing this same bias, begin to relax their lending standards. This is the participating function. These actions now have a direct impact on the fundamentals. The surge in buying and easy credit causes housing prices to rise dramatically. This change in the reality of housing prices now feeds back and reinforces the original flawed perception. The rising prices appear to prove that the initial bias was correct. This in turn encourages even more buyers to enter the market, and banks to relax their lending standards even further. A powerful self-reinforcing feedback loop is now in motion. The perception that prices will rise creates the reality of rising prices, which further strengthens the perception. This is reflexivity. This feedback loop is the engine that drives the boom-bust model that Soros famously identified. The boom phase is this period of self-reinforcing ascent, where the market's perception and the underlying fundamentals chase each other upwards in a spiral. However, this process cannot go on forever. Eventually, the divergence between the market's euphoric perception and the underlying economic reality becomes stretched to a breaking point. The fundamentals can no longer support the inflated prices. At this point, a catalyst, perhaps a rise in interest rates or a spike in defaults, pricks the bubble. The moment the perception shatters and people realize that prices can, in fact, go down, the reflexive loop violently reverses. The cognitive function changes to housing prices are falling. The participating function becomes sell at any price and tighten all lending. These actions create the reality of collapsing prices, which in turn reinforces the new pessimistic perception. The self-reinforcing boom becomes a self-reinforcing bust. This brings us to one of the most profound debates in finance, a direct conflict between classical economic theory and Soros's framework. We want to hear your view. Before we continue, tell us in the comments. Do markets simply reflect the underlying economic reality as traditional theory suggests? Or do they, as Soros argues, actively shape and create that reality through these powerful reflexive feedback loops? The synthesis of these two core concepts is what defines Soros's unique approach to risk. Because of fallibility, he knows that any prevailing market trend is likely based on a flawed premise or bias. And because of reflexivity, he knows that this flawed premise can, for a time, become a powerful, self-sustaining reality that can carry prices far beyond any rational valuation. For Soros, the greatest risk is not simply being on the wrong side of a trade. The greatest risk is being on the wrong side of a powerful reflexive process when it reaches its breaking point and violently reverses. The psychology required to navigate such an environment, to recognize one's own fallibility while a powerful trend is seemingly proving you wrong, is immense. This internal battle is timelessly captured in the classic work on market psychology, Edwin Lefebvre's Reminiscences of a Stock Operator, authored based on the life of the great speculator Jesse Livermore. While its original lessons are foundational, their century-old context can be a barrier. To make this wisdom directly applicable for today's market participants, we have linked in the description a specific and updated resource, Reminiscences of a Stock Operator, 2025 Annotated edition. An in-depth, chapter-by-chapter analysis for the modern speculator by Max Davidson. This new edition translates the original's core lessons with detailed modern commentary, making it essential reading. Grasping this psychological dimension is critical because Soros's entire methodology, which we will now explore, is a system for identifying these reflexive processes, participating in them, and, most critically, exiting before the inevitable collapse. His focus is, above all else, on survival. As he famously said, "My approach works not by making valid predictions, but by allowing me to correct my false ones. Having established the profound intellectual framework that guides George Soros, the twin pillars of fallibility and reflexivity, we now transition from the realm of abstract philosophy to the world of concrete action. How does a philosopher become the world's most feared and successful speculator? The answer lies in the creation of an operational process that is a direct, practical extension of his worldview. Soros does not use his philosophy to predict the future with certainty. Instead, he uses it to generate powerful, often contrarian hypotheses about potential market disequilibria. His trading is a continuous process of formulating these hypotheses, testing them in the crucible of the market, and, most importantly, having a predefined process for acknowledging and correcting his errors. This section is a deep dive into that operational process. We will deconstruct how Soros formulates a trade, his unique approach to risk, and we will analyze in granular detail the single greatest trade of his career, the one that serves as the ultimate proof of his reflexive theory in action. The Soros trading process begins not with a chart or a balance sheet, but with the search for a flawed premise. He is, in essence, a hunter of misconceptions. He scans the global macroeconomic landscape, looking for a widely held belief, a prevailing market consensus that he believes is fundamentally at odds with an underlying reality. This disconnect is the necessary starting point for any potential trade. He understands that markets can remain irrational for long periods, but a significant gap between perception and reality creates a tension that must eventually be resolved. His goal is to identify this tension before the rest of the market does. Once a flawed premise is identified, he formulates a hypothesis for how this disconnect will resolve itself. This hypothesis is not just a simple directional bet. It is a complete narrative that outlines how a reflexive, self-reinforcing process might begin, and what the potential catalysts for its acceleration or collapse might be. To operationalize this, Soros often thinks of markets as existing in one of three states. The first is a state of near equilibrium, where perceptions and reality are reasonably aligned, and price movements are largely random noise. In these conditions, there is no significant edge, and he remains largely inactive. The second state is a far from equilibrium condition, a reflexive boom-bust process where a self-reinforcing feedback loop has taken hold and a powerful trend is underway. The third state is an inflection point, the critical moment where a far from equilibrium trend is about to exhaust itself and violently reverse. The majority of his profits have been made by identifying these inflection points, the moments where a prevailing bias is about to shatter. It is crucial to note that in the execution of these ideas, particularly during the quantum fund's most successful years, Soros worked in close partnership with his brilliant lead portfolio manager, Stanley Druckenmiller. Druckenmiller was often the generator of the initial hypothesis and the master tactician responsible for the day-to-day execution, while Soros provided the overarching philosophical framework, the capital, and the unparalleled courage to bet on a massive scale when their conviction was highest. One of the most unique and misunderstood aspects of Soros's process is his use of his own physical and emotional state as a risk management tool. He has spoken frequently about how the state of his portfolio manifests as a physical sensation. He famously stated, "When I was actively running the fund, I suffered from backache. I used the onset of acute pain as a signal that there was something wrong with my portfolio. The pain in my back was not directly related to the mistake I had made, but it did make me look for one. And more often than not, I found one. This is not mysticism. It is a form of highly attuned subconscious pattern recognition, a skill honed over decades of intense, all-consuming focus on the markets. The pain is a signal from his subconscious mind that there is a flaw in his conscious hypothesis, or that the size of his position has exceeded his true level of conviction. It is a biological early warning system that forces him to re-examine his assumptions with a critical eye, a physical manifestation of his own principle of fallibility. The ultimate case study in the Soros methodology The trade that perfectly fused his reflexive theory with his aggressive risk-taking was his legendary 1992 speculation against the British pound. This was the trade that earned him the title, "The Man Who Broke the Bank of England," and netted his quantum fund a profit in excess of $1 billion. To understand this trade is to understand his entire philosophy in action. The story begins with the flawed premise, the European Exchange Rate Mechanism, or ERM. The ERM was created in the late 1970s as a system to reduce currency volatility and create monetary stability in Europe, a precursor to the modern euro. Member countries were required to keep their currency's exchange rate within a narrow, predefined band relative to the powerful German Deutsche Mark. Great Britain joined the ERM in 1990. The fundamental flaw, the misconception that Soros and Druckenmiller identified, was that Britain had entered the system at an exchange rate that was too high. The pound was fundamentally overvalued relative to the Deutsche Mark, making British exports uncompetitive. Furthermore, by the early 1990s, Britain was suffering from a deep recession. The correct domestic policy would have been to lower interest rates to stimulate the economy. However, the rules of the ERM required the opposite. To keep the pound's value high within its designated band, the Bank of England was forced to keep interest rates artificially high, deepening the recession. This created an unsustainable economic and political conflict. This was the perfect Soros setup, a widely accepted market structure, the ERM, that was based on a fundamentally flawed premise and was creating a growing, unsustainable tension between perception and reality. Throughout the summer of 1992, Druckenmiller and the Quantum Fund began to build a short position against the pound, betting that this tension would eventually cause the system to break. They started relatively small, testing their hypothesis. The catalyst that transformed this trade from a good idea into a near certainty came from Germany. The German central bank, the Bundesbank, was facing its own domestic problem of inflation after the reunification of East and West Germany. To combat this, it was keeping German interest rates very high. This forced other ERM members, including Britain, to maintain high rates as well, exacerbating their economic pain. In a series of public statements and leaks in September 1992, the president of the Bundesbank hinted that he would not endlessly support weaker currencies and that a realignment or devaluation of some currencies was necessary. This was the signal Soros was waiting for. It was a crack in the facade of official unity, a sign that the flawed premise of the ERM was about to be exposed. This is where the operational strategy shifted from probing to attack. Soros and Druckenmiller recognized that this was a once-in-a-generation opportunity, a true asymmetric bet. The downside was limited and definable. If they were wrong and the pound remained in the ERM, they would suffer a small loss. The upside, however, was immense. If the peg broke, the pound would likely collapse. In a now famous conversation, Druckenmiller explained to Soros that he was planning to massively increase their short position. Soros's response was legendary. He encouraged him to be even more aggressive, to bet the entire fund and more, famously stating, "When you have tremendous conviction on a trade, you have to go for the jugular." Over the next few days, they increased their short position to an unprecedented size of over $10 billion, using leverage in the futures and forward currency markets. They were no longer just predicting a crisis. Their massive position was now actively contributing to it, a perfect example of reflexivity in action. The climax came on Black Wednesday, September 16, 1992. The global currency markets, sensing the pound's vulnerability and seeing the massive pressure being applied by Soros and other speculators, began to sell the currency en masse. The Bank of England was forced to defend the peg. It entered the market using its foreign currency reserves to buy billions of pounds in a desperate attempt to support its value. When that failed, it announced a dramatic interest rate hike from 10% to 12%, and later in the day promised a further hike to 15%. But the selling was too relentless. The market, led by Soros's immense position, called the central bank's bluff. By the evening, it was clear that the Bank of England had exhausted its firepower. The British government was forced to capitulate, announcing that it would suspend its membership in the ERM and allow the pound to float freely. The currency immediately plunged in value. The flawed premise had shattered. The result for the Quantum Fund was a profit of over $1 billion in a single trade. It was the ultimate validation of Soros's entire intellectual framework. The market's perception of the pound's weakness, when activated by a powerful catalyst and amplified by Soros's massive bet, became a self-fulfilling prophecy that destroyed the flawed reality of the ERM. This legendary trade and his entire career can be distilled into a set of principles for survival and risk management. These are not rigid rules, but a flexible philosophical approach to operating in an uncertain world. The first and most important principle is that survival is the only objective. Soros once said, "If I had to sum up my practical skills, I would use one word: survival. It is the most important thing. If you're in the game, you can win. If you are out of the game, you cannot. This means that the preservation of capital is always the primary goal. No single trade, no matter how high the conviction, is ever worth risking ruin." This mindset is what allows a speculator to endure the inevitable periods of losses and to be psychologically and financially prepared to act when a true opportunity arises. The second principle is to admit your mistakes instantly and decisively. This is the practical application of his philosophy of fallibility. The moment the market provides evidence that your initial hypothesis is wrong, you must exit the position. There is no room for ego, hope, or the desire to get back to even. The size of the loss is irrelevant. The real crime is staying in a position when the original reason for entering it has vanished. He famously stated, "I'm only rich because I know when I'm wrong." I basically have survived by recognizing my mistakes. For Soros, a losing trade is not a personal failure. It is a falsified hypothesis, a piece of new information that must be acted upon immediately. This ability to take a loss quickly and without emotional baggage is what allows him to clear his mind and reevaluate the situation objectively. The third principle is the mirror image of the second. Bet big when you have conviction. This is what separates him from the average risk manager. When a trade is working, when the market is confirming your thesis, and when you believe a powerful reflexive process is underway, you must be aggressive. This is what creates the massive asymmetric payoffs seen in trades like his bet against the pound. Most traders do the opposite. They take their biggest positions when they are most uncertain, driven by a need for action, and they take small, quick profits on their winning trades, driven by a fear of giving back their gains. Soros's approach is to make very few very large bets, but only when his analysis suggests that the odds are overwhelmingly in his favor. Finally, Soros operates with the principle that the market is amoral. A speculator's job, in his view, is not to pass moral judgment on a market or a currency, but to identify and profit from inefficiencies and flawed premises. His bet against the pound was seen by many in Britain as a hostile, unpatriotic act. For Soros, it was simply a logical response to a fundamentally flawed and unsustainable economic policy. His strategy is to be a clinical, detached observer and participant, acting on his analysis of the system as it is, not as he wishes it to be. The first step in building a successful system is building the habit of disciplined study. The philosophy of George Soros is not an abstract theory. It is a set of principles that requires deep reflection and reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the enduring legacy of George Soros is that he elevated speculation from a mere gamble into a form of applied philosophy. He is arguably the world's greatest speculator, not because he possesses a secret formula for predicting the future, but because he has developed a superior framework for understanding the present. His success is the product of a rare and powerful combination: the intellectual rigor of a philosopher, constantly questioning his own assumptions; the courage of a high-stakes operator, willing to bet massively when his conviction is highest; and the profound humility to recognize his own fallibility and correct his mistakes without hesitation. He has proven that in the chaotic arena of the global markets, the most powerful asset is not a more powerful computer or a better piece of information, but a deeper understanding of the flawed, recursive, and endlessly fascinating nature of human reality itself.